Hi, welcome to another episode of Vantage Point by DJ Janus. Our season 2 is absolutely going to be a blockbuster because we are having such great guests. But in all the guests we have had today is a very special episode because today I'm also stepping out of my comfort zone to not only talk about the technology side of things but also how investing is being done, how it is changing, and I'm really glad to welcome Gareth from Nomura to be a part of this. I must tell you, we are very lucky that he's on this show because, I see him on CNBC and all these big shows, and talking to Bloomberg. So very lucky that he has decided to, use to be on the DigiJanus platform. Welcome, Gareth.
Well, thank you very much. It's an absolute pleasure to be here. I've been watching your stuff for a while and really happy to be involved.
Thank you. So now, I know everybody on our episode, on our audience would know you, but please, I would love for you to introduce yourself. And
Sure. Let me start from the beginning. So I'm actually come from South Africa. I grew up there. I was a school teacher, mathematical school teacher, arguably my favorite job to date. I moved from South Africa, moved to the UK. I was a fund manager and investment professional there for just over a decade. And now I've been in Singapore for 11 years, managing money, managing investments, tying together technology and investments, and just trying to look after clients' wealth. So that's, in a nutshell, my story. There's been a few bumps along the way. There was Lehman's. I was involved in Lehman's, trading derivatives a lot. The credit crisis in Europe, which maybe we'll see again, who knows, given what's happening. And then in Singapore, the real exciting bit has been this transformation of Asia, China, and the growth. So really excited to be here.
thank you. So, Gareth, first of all, great story. I want to, know more about how you went from teaching maths to, running funds for some of the richest people, in Asia. But let's talk a little bit about, your day-to-day role. What do you do at Nomura? How are you looking at things? Let's start with that first.
Sure. So my role is a chief investment officer at Nomura, and Nomura Investment Wealth Management. So that is the arm of the bank that focuses on high net worth, ultra high net worth family offices. I'm pretty fortunate that my role is really is merging all the best of Nomura together. So Nomura has been around for nearly 100 years. Can you believe it? I heard a statistic earlier on today, actually, which was saying that in '88, Nomura was the largest business in the world. Oh, wow. Literally when Japan was the largest, investor and holder in the world. So Nomura has been around for a very long time. They have so many fingers and so many different pies. They're specialists in so many things. My role is to try bring those together from an investment perspective and put those in front of our clients so that we can benefit. Because arguably, really, the only free lunch in investments is diversification. And to do that, you need to bring a lot of different pieces together.
No, absolutely. And Gareth, very excited to have you. You've given us some really good pointers there. Now, one of the things that I see you talk really passionately about is, rather two things that you talk really passionately about is, one is use of extensive amount of data, whether it is alternate data or market data, etc. And then the use of technology and how it is changing the world of investing. So let's dive into that. So how is technology changing how investment managers invest money for, anybody right now?
Well, I think data and technology is fundamental. To be honest, my story, if you start right from the beginning, technology helps opportunities find me. Because as a maths professor, I didn't really have a strong finance background. I was more focused on, mathematical side of things, understanding the logic. The logic flows into in programming technology. So I was able to arguably automate my role away. I kept on making my role redundant so I could move up and focusing on more data, more experience, until you get to a point where there's just too much data, too much uncertainty to automate. And I feel that's what investments is about. It's about the idea of you're never going to have lack of information. It's about reducing that filter failure. There is just so much information. We have to try condense it and understand it as best as we can at this moment with the tools we have. And that's why I'm so excited that technology is just caught up to the mainframe. If you forget, when I was studying many years ago, there was no such thing as machine learning or AI really. It was statistics. It was basically the same thing but packaged a lot better nowadays. Now people are excited about statistics, about machine learning, and I think this has really transformed the industry, and it's just going to do more and more over the next few years.
Oh, that is very exciting. Now, you talk about AI, machine learning, and statistics. Now, there is a lot of technology out there, which can look at events, which can predict events, etc. How successfully or how well is questionable, and a very different discussion. Now, talk to us about 2 or 3 technologies that you have looked at, which you are like, yeah, this could change how we invest our money.
Well, I think the caveat there would be there's a bit of a joke in the industry, in the sense that you go to school, you go to university, you learn differential equations, abstract algebra, all the rest. You come to work in finance and you start with Excel and you stick with Excel. So there is so many professions that are still working on the basic statistics, basic Excel kind of knowledge. But I really think over the last maybe 5 to 10 years, it's become mainstream to start thinking, how do we deploy the next level information? So if we had to break it down into 3 interesting spaces, would be AI and machine learning, how we can use huge amounts of information and making different inferences that maybe we wouldn't pick up by ourselves. It would be IoT, so the Internet of Things, being able to understand what is happening on a corporate level with much more clarity, instead of this 3-month lag from earnings. It's more like nowcasting and really getting information. That's going to transform the understanding and the speed to market. I think that's really key. And then also from a practical perspective, there's a lot of interesting platforms that don't require any coding anymore. We have experts that are economists, that are lots of real field practitioners, but they don't code. They don't need to code. Now there's options that you can actually use low code or no code solutions to get so much more out of the data. So those are the 3 I think are most important at the moment.
Right. And now I want to ask you a question. I don't know if you've seen the format. We always have like a difficult, tricky question that we ask you, whenever we can. Algorithmic trading is a very big part of the industry today. And it has also been linked to a lot of flash crashes in the past. Now, as the industry moves towards more dependence on algorithms, and most of these algorithms have some amount of similarity, if not a large amount. What happens? Is this a systematic risk that everybody moving towards algorithms and AI, machine learning to invest such large chunks of money? Is it a systematic risk that tomorrow a lot of these algorithms will have, like, let's say there is an event and, even if it is a false flag, their, red lights are blinking and they're selling this stuff, tuck, 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 and, you have a systematic crash. Is that a real possibility? And how would you manage that?
Well, thanks for the question. It is a tough one, but it's a good one, I think. I think this we're already seeing. This we've seen over the last few years, when you've got spikes in volatility more frequently than in the past. And arguably a lot of this is due to quicker trading. I think the real risk to me is not the use of technology. Being more systematic on the way you trade, taking out some more of the emotion is a good thing, because that's, money and investing is very emotional. You can get tired or married to a trade. So having a structure to take that out, fantastic. I think that the difficulty we're noticing more recently is the sample set that the machines are learning from. If they're all learning from a sample set that's only 10 years old or 15 years old, well, that market is not a representation of the last 50 years. Traders that have only been in the market for 10, 15 years are really worried now, because you're seeing inflation at 40-year highs, rates moving up to levels we've never seen. So if the machines have only learned from that data set, you've got problems. So I think it's really important to understand how much learning, how much information the machine is taking in, because that's going to dictate where they go. If they're all focusing on the same thing, you're very likely to get the same sort of problems. But I definitely wouldn't say the risk is too high that you should stop trading algorithmic. I think that is the future to a point, but at least in my lifetime and maybe the next generation, it's the combination of machine and human where it's the sweet spot.
No, absolutely. And you made a very, very good point there. Now, any algorithm which is based on 10 years of data, that algorithm has only seen a bull market. So, that would find it, I think the algorithm will be out of place when it sees what is happening today. Now, here comes the first tough question. So this was not enough question. So the first tough question is, I also believe like not doing it is not an option.
Yeah.
How can the regulators prepare for a world where algorithms are trading such high amount of volume and, on discretionary portfolios and etc.? How can regulators prepare for this future?
Well, I think it's a bit like all of us that have realized that you can never stop learning. Regulators have to, and I think they are. They're dialing in. They're getting more supportive of new technology because they realize if they fall behind, they're in trouble. They need to understand, crypto markets, blockchain, machine learning. There's so many forums within regulators where they're trying to get up to speed in the space, and you have a lot of PhD professionals in the space trying to keep people ahead. It's the same as our industry. We go to clients with a new idea. We need to provide the education to share. We need to get everyone up the curve. So I think that is the big challenge now, is to educate to a level that people understand what's going on, but not so much that people lose interest or they scare them away. And it's finding that balance that's is pretty tricky. Regulators have to understand that balance and more, because they obviously have to look for worrying signs.
Right. No, absolutely. And I think it is about finding the balance. Now, when I hear you, it is very easy to draw this conclusion of man versus machine, which is our very like everybody's favorite narrative when it comes to AI. Are all the sell side analysts and all these analysts, etc., going out of jobs?
Well, there is if you look at trading floors, definitely the number of people that were in trading floors is halved or more. Yep. And I do believe there is a push for traders that code. People, if they were a specialist in a certain space, and they're not, I'm a bit more of a generalist nowadays, but if you're a specialist in a certain space, certain parts of the investment curve, universe, you need to get the most out of that information. And arguably, the level of information requires some sort of automation. Now, can computers do all of it? We have seen over the last few years, yes, there are certain parts of the food chain which computers just do better. But at the same time, as we talked about, computers are backward looking. They require a history that has happened for events that are different, that are changing continuously. And arguably, we're in an environment where we're not certain what's going on. Yeah. Had a lot of meetings recently, and investors are like, humble pie. We don't know what's going on, but we think this is the best choice, and we balance it out. That's when the humans can come in with more, creative ideas. And the balance between the two of having, this is what the data says, this is the probabilistic outcome, and this is what we think might happen. How do we tie these together? That's a sweet spot. So losing jobs, but new jobs are created for people willing to shift their focus and keep learning.
Okay, and you are playing a big role in the private banking side of Nomura, and every time we have a guest, who's from wealth management, one of the biggest topics is, personalization or hyper-personalization. Now, private banks are already built on personalization. You, as an RM, you have 10, 15, 20 customers, so you know them inside out. How do you see technology changing that dynamic?
Well, I think hyper-personalization used to be a nice to have. Some banks had it, was great. Now I think it's essential. I think every bank is going to have some sort of hyper-personalization when it comes to clients, because clients demand it. You've had the day-to-day technology. You call it social media. You call it you're buying on e-commerce. It's hyper-personalized. We're so used to this service and really being, you can dive into your history. You can see what's going on. You can see what your transactions were. They recommend what you should be looking at. This is now, stock standard. And banks have to be thinking that way as well. Particularly an industry which is so data intensive and data important, we need to be thinking that way. So for private wealth clients, I agree with you. This is something that's just going to evolve, just going to get better. I think the real challenge and the real opportunity as well is being able to try to remove some of the noise. People in investments are bombarded with information. So much information that it just becomes more difficult. We need to try filter out the most important noise, have a priority focus point when someone turns on the computer, picks up their phone. This is what I feel is most important for me to look at now, but that requires trust. So we need to bring in hyper-personalization with this idea of growing trust. They trust that your top 5 is what I should be looking at, instead of that top 5, that top 5, that top 5, and make my own top 5. So that is the key now, is again, the human and machine. We use the machine to help us focus, but we have to use the human to still maintain that trust. And I think after COVID, the trust is probably even more important, given we've been sitting at home so long. Now face-to-face just becomes really, really nice.
No, and absolutely. And I think, as you said, it is going to be essential, and it is going to be even more essential when it comes to the next gen. You have 70 trillion in assets going to the next generation, right? How are you guys preparing for working with your next gen customers?
I think Asia, the next generation, is even more exciting. I'll just give context there. So when we're talking about wealth in Europe, spent a fair amount of time there, you're talking about families with generations of wealth, right? Older money. So arguably, as the money goes from the principal that made the large percentage of the money in most cases, it's getting passed down by generation to generation, where the interest in making the money becomes less, the interest in preserving the money and steadily growing the money becomes more. That is where an investment professional becomes ever more important because it's about diversification in those. In Asia, we're at that crux. The wealth was only created one, maybe two generations in most cases. You're now passing to the next generation, which some of them want to be involved, some of them don't. The principal is sometimes involved. It's a lot more personalized. It's a lot more understanding this specific family because no two families are the same. No two ultra high net worths are the same. So yes, you've got to have that technology. You've got to bring that trust in. It's about education. It's about helping maybe fill the gaps with the new generation. And how do they learn? How do they consume information? It's through digital. So a large amount, I think, is going to be shifting to in the new generation about digital information. That could be more interactive charts, could be more interactive messaging, it could be more dynamic presentations instead of over a lunch or something like that. That space, I think, is still very, very fresh. Not many people are doing it very well at the moment. I think there's some really interesting platforms which provide that interaction, and that's growing. But I think that's going to be the key to be able to connect with the new generation, is being able to speak their language, digital language, in an efficient way as well.
You really touched upon a few very important points. So speaking the language. Now, digital assets, as you talked about, so not talking about blockchain, that is the technology. Let's talk about digital assets, Bitcoin, Ethereum, etc. It has, we have seen it find a lot of appeal to, the next gen. Now, and you are talking to the current gen, next gen, etc. So I want to ask you this. What is the appeal of Bitcoin or digital assets to the current gen and the next gen, and how is it different?
Well, I'll be honest, this is probably a more difficult question for me. I have a personal interest in the space. I do some investing. I like the space, and I think it's a space that you can't ignore. From a business perspective, Nomura likes it as well. We've set up a digital asset management, a digital company. I won't add any more detail there. It's an exciting space. I'm looking forward to getting involved. And it will be touching on all these new asset classes as they evolve, right from the protocols to the different asset classes, the different coins, the different exchanges. And I think that's probably the next grown-up step, is having the trust of a bank tied together with some of the new technology. Yeah. That's going to make it, we're not going to have another winter if we have the stability of the both technology. So I think the appeal is, this is an asset class that people understand. They use digital all the time. They understand, Web3 in the case of transacting money online. They trust the concept of cash. They don't have to hold cash anymore. Yep. So I think that's really interesting, and it's really hits a nerve for a lot of young investors, which maybe weren't able to get on the ladder, the old ladders, being real estate, being some of the traditional asset classes. Yep. And this has offered an opportunity, and it was a great run, right? But I think, like anything, it just ran too fast, too hard. So this needs to pull back. We need to get some consolidation. I honestly believe that you need a bit of the trust factor, the older school trust factor, just enough that this is going to be interesting. And then, the youth are going to get involved. And I know I'm diving on this, but I think it's a really interesting part of the world. I personally feel the next big move in the space is going to come from central banks. I think the trust factor is going to come when we have digital currencies coming through, probably from China first, the most material one. Then it's going to be other economies. This also plays into another topic of digital security. But if you have central banks providing the platform and the security, you can then go on the top of that, more interesting products, more trustworthy products. And I think this is going to grow the space. So if anything, I think this has been a really good clean out of the whole space.
Okay, and I have two questions to follow up from there. And now I'm going to put you another tricky spot. One is, Bitcoin or digital currency is highly polarizing topic today. Why is it that some people look at it as an opportunity, whereas some people look at it as the tulips of the digital world? Why is there so much polarization around Bitcoin?
Personal opinion is investors normally want something backing it up. It's trust, right? We're buying a piece of, just think about it, we're buying a piece of, printed paper. This is, pulped up wood, piece of paper, you put a bit of ink on, you put a US president, you put a $100 bill in there, and people can take that piece of paper anywhere around the world and at the moment get a lot for it. Yeah. What are they doing? They trust in the underlying. They trust in the US government will back that. Bitcoin, for a lot of traditional investors, are saying, okay, I'm buying into this, but who am I trusting? I'm trusting a protocol that could be changed tomorrow. I'm trusting a certain set of people are going to maintain this, but we don't know, is the set going to get smaller so it becomes more efficient or not? How's this changing? There's so many other versions. So I think there's a level of trust. Some people are maybe a little bit more risk takers and they need a less level of trust to get involved. And I think that's the pioneers who've really dived into the space. Other people are waiting for a bit more of a trust factor. And maybe to my biased view, I think the trust factor is going to come from when you have institutions stepping in and saying, we trust this and we back this to a point.
Yep.
Yeah, so it doesn't have to be, US dollar backed or the like, but it's more the kind of bigger picture.
No, absolutely. And now the most interesting question. You touched upon CBDC, the central bank digital currency. Now, while it seems like a great idea, there has been questions around, privacy and monitoring and, tracking of behavior and how you are spending your money, because the biggest advantage of blockchain is that everything is there forever, right? Now, what are your thoughts on, using currency that can be tracked, monitored, blocked at any point of time by the government that is issuing it?
Well, I think the hot topic around the world now, where this ties together, is this idea that if we look back at the point where the Russian-Ukraine crisis kicked in, the big shift is the new focus on security. In the headlines, there's energy security, food security, but it's also going to be digital security. These sanctions have shown the power to basically close off an economy, to shut down. So I really think that was a major boost for the importance of digital currencies from an individual perspective. I think we're getting to a world where we're worrying much more about ourselves than our neighbors, unfortunately so. But if you're worrying about yourselves, you want something that you can control if relationships break down. So for that reason, I do think that digital currencies are going to be evolving at different points. They're going to be much more locally censored. The tricky bit is plugging the two together when you work global trade. That's going to take a while. Yeah. I think the other tricky bit is the fact, talking about the dollar. That's probably one of the best products in the world, right? You print a piece of paper that costs you 0.001% to make, and you can sell it for a huge profit. So if you take that away, there's a source of revenue that's also going to disappear. Yeah. So I think, like the energy transition, this will happen, but it's going to take time, and there's going to be stumbling blocks before we can totally get rid of coal. There will be stumbling blocks before we can totally get rid of fiat or other currencies. But I think the trend is pretty clear. This is something that's coming. Yeah. I'm not brave enough to put a timeline on, to afraid when.
Oh yeah, absolutely. I think nobody's brave enough to put a timeline. But you did mention some really interesting points that, when you are worried about, all kind of securities, digital security becomes, a very big part of it. And, that is something that I had not at least thought of. And when CBDCs come in, I get a little nervous. I'm very excited about the technology because of the innovation it will bring in. But I also get a little nervous that, everything you do is now being recorded. Like, not that it is not recorded today, but, it is recorded, it is available. But I think you have to just balance things out, as you previously mentioned. So, amazing answer. Now, in the next segment, we want to dive into, some of the parts that you mentioned, how the world is changing and, how you are looking at different risks and etc. So, that is what we want to talk to you about next. Gareth, this next segment is going to be really exciting. And I think for you, because you talk about this, on day in, day out. So, we are living in a very different world than any one of us would have imagined 3 to 5 years ago. There are so many risks that we are managing. And so what are 3 to 5 things that you are looking at? And, what is your economic outlook for some of the major economies that in the next 6 to 12 months?
Well, like you said, it's pretty tough out there at the moment. There's lots of ugly storms growing. It's probably key just to try to break it down and see where the big storms are. So in the US, the main one that we've noticed the biggest change is the idea that the federal bank, the people that print the money, that support the economy, they actually are not looking to support the economy. They're looking to get price stability, meaning they're trying to get inflation under control. Yeah. This is going to happen with the idea of trying to slow down the labor market, slow down some of the growth, slow down some of the sentiment indicators like the equities market. They need to do that to be able to really bring inflation down. Inflation has been driven by many things. One of it is energy. We know that underinvestment in energy over years has caused this backlog. Yeah. I think the Russia-Ukraine crisis was the big, the needle that broke the camel's back. So that's obviously how that is playing out. That's affecting Europe. The major economy is under even more stress in the US at the moment. The other one is China, which has been the engine of growth for so long, and it has really struggled with the three Ds. Disease, arguably drought, and the energy crisis there, and then debt. You've got mortgage. You've got a lot of the problems within that part of the economy, and now they're going into a big political cycle, and how they're going to balance the two. Stability for politics to ensure that the people are happy and they can do what they want to, alongside with this incredible growth expectation that China has. It is the engine of the world. So I think those are probably the three big ones, three big economies. The other ones that are nearly as exciting is Japan reawakening after such a long time. We think that's super exciting. And then the deglobalization means big economies are becoming ever more important because they're looking after themselves. So India, Indonesia, ASEAN, another space that's really exciting. Got their problems, but I think they've also got some really interesting tailwinds. So hopefully a balance of negatives and positives.
Right. So now you've mentioned like some really interesting points there. Now let's go step by step into that. Now, the first part was the Fed. So you mentioned that Fed is now looking to control inflation, and we have gone from inflation is transitionary to where we are today. There is a popular opinion that Fed and some of the other regulatory ECB, etc., are behind the curve by a huge margin. Are they doing too little, too late?
Look, on a historical perspective, normally you have the Fed's funds rate, which is what they can control, getting as high as inflation for them to actually put it under control. So Fed's funds rate now it's 2 and a bit, and inflation at 8. Are we really going to get there? So if you look at it from that lens, they're behind the curve. But arguably we're in a different environment where they don't need to act as aggressively. They can also talk up a lot of the aggression. The market is also supercharged, be it algorithmic trading or just the news flow that happens. So things move much quicker today than, for instance, they did in the 70s. So yes, they've got work to do. Over the last few weeks, they've reiterated across the central banks that they're going to put the work in, the hard work, the painful work. So what we see is inflation starting to come down, but gradually. From as early as September, this next CPI prints in 13th of September. That's going to cause pressure on the growth. We actually see our house view is 5 negative prints of GDP. So this is a long, slow, painful process. That is arguably leaning more towards a hard landing than a soft landing, because if the economy is going to slow for longer, that's going to affect people's pockets, corporates' earnings, and arguably corporate earnings are not pricing in such a big slowdown at the moment.
Right. So when you say hard landing, what would a hard landing look for the average person out there?
Well, to me, was COVID a hard landing? I mean, it was a tough time, right? But from an economic perspective, super sharp, super way up. Disposable income actually was very beneficial. A lot of people are actually sitting with more money the government gave, savings from not traveling in, other reasons. There was a recession that came out pretty quickly. Arguably, that one was not as painful as a prolonged deterioration, which is going to see recession after recession. I don't think we're going to get to a hard landing where we're talking anywhere near the word great coming in front. The Great Depression, the Great Financial Crisis. I don't think we're going to have that kind of environment, but we're all going to have a prolonged recession. So really, sitting on the fence, I think this is between a hard landing, an event that needs the greats in front, and a soft landing, which is we're going to be able to carry on pretty much as normal pretty soon. This will affect a lot of people.
Right. And you mentioned deglobalization. That has become a very interesting topic. They're calling it friend sourcing, and we should work with people who have very similar views as us. How do you see the world changing in light of the current geopolitical events? Are we splitting into two blocks again?
Well, let's take a step back. I don't think this has been around for a little while, because I think the two big economies realized that the key thing to the survival of both was technology, was the ability to provide high-tech equipment, machinery, technology. And if you were having a monopoly in one, the other was feeling very nervous. And this is why we've had tension between China and US for a long time, given that shift of balance has moved. Many people expected that shift of balance would basically be change of superpower number one. This may take a little longer, maybe not. But I think the next big shift we've seen is geopolitics with regards to Russia and Ukraine. That has brought in the idea, we talked about it early on, about security, and particularly energy security. So for years now, we've been talking about transition of energy, which will happen, which needs to happen. We look at what's happening on a weather basis. But now we have the muddy bits of transition of energy also means transition of power. Geopolitically, the energy providers have hold a lot of power. Now, as they're potentially getting closer to the end game, they have to hang on to that power. They have to maximize that power. That's going to see far more tensions growing as you're trying to get this shift out. And that's going to cause blocks because people need power to grow. Growing economies, growing populations need power. So if you're going to isolate certain parts, like this recent European cap on power, that's going to push people other ways. This is going to really split it. So we've had the tech divide, which wasn't much of a divide. Yeah. I think the energy divide is going to be the first big push for deglobalization. And then that could flow into other things like food security, cyber security, supply chain security, have factories in your own countries or your friend sharing, that kind of things.
Yep. Okay. So, we are looking at a very gloomy world from what we have discussed in the last, 5 to 10 minutes. What are 2 or 3 positive things that you see coming out of this?
Well, look, the economy is still pretty dynamic. Things are changing. There's going to be innovation that will change the energy story, will change the investment story. So I think these points of change are interesting and important. You have crisis and then you have some sort of innovation bringing that up. Right back to the Depression, then you had electricity kicking, you've had internet, you've had a number of different things. So potentially there could be a big shift in technology that's going to really shift things around. Maybe it's a technology around energy, which I think is fascinating. It could be AI. It could be really understanding the information around the world and being able to make better informed decisions. One of the struggles is around political decisions, political mistakes. And maybe we're going to see a shift. This is enough of a momentum to shift people into that space. In a more practical sense, I think what this is highlighting is, as an investor, we can't expect home runs anymore. You can't expect these great one-off trades. We need to, if you don't mind me using a sports analogy, we need to fill the bases with solid hitters. These could be income producers from numerous different sources of income, but that's going to be better than one home run. It's going to be filling them up and constantly moving it around. So as investors, we need to think about diversified forms of income. What is the best way for you? And partner with people that can provide those truly diversified. We saw with, going back to your earlier point about why crypto, some people don't like it. The correlation is just so high. Everyone's doing the same thing. There's very little pure diversification there. So I think we're looking for that true diversification.
No, absolutely. Okay. And you talk about, investors and ultra high net worth investors. What are 2 or 3 things that they're most worried about at this point of time?
To be honest, ultra high net worth and family office and those, I think the main one is capital preservation. We shouldn't forget that these families have made majority of their wealth. It's very unlikely they're going to triple or quadruple their money at the same pace they did from when they were, only rich to ultra rich. Yeah. So the real fundamental, discussion we have with clients is how do we maintain or preserve that wealth, and we grow it at a stable, constant rate. Now that stable, constant rate differs per client, but it's still a stable, constant rate. I think that is probably the key requirement. And to do that is what strategy you're going to have. Because we talked about it earlier on, the idea of taking away emotion out of investing is really important for a stable portfolio. There's a lot of talk about shifting the 60-40 model, the bonds equity model. Some people are saying as much as 40% in alternatives. I'm probably leaning more towards kind of a model of equity 30, bonds 30, alternatives 30. Over the long term, we have to kind of scale in there. At the moment, our house view is about 10% in alternatives, but I think that's going to grow over time. And alternatives, anything that produces a regular income that has a low correlation, that is what clients want. They want that stability. Not very sexy. I wish I could say it's everyone's worried about missing the crypto ride.
No, absolutely.
But I think it really is about stability now in this environment.
Right. And when you talk about capital preservation, how would you preserve capital in today's world when there is an inflation of 8%? So the money sitting in the bank is also devaluing by 8%. So how do you preserve capital while managing risks?
Well, exactly. You need to find areas that you think you understand. You can manage the risk for the return. So when I say that is, for instance, at the moment, investing in crypto for me is not that exciting because I feel the risk is just so much higher, the uncertainty, than the return that I expect. So I look at assets that I think are particularly interesting. I have a certain part that will be in a fixed income, a regular income, some that will be involved in REITs that will provide an income from that space. At the same time, I think it's important that all investors look for partners that can offer some sort of speciality or edge in a certain space. Like certain banks that are based in Asia will have much more focused view on Asia and will understand it better than maybe banks based in the US, which will understand that space. One is not better holistically than the other, but at certain spaces they are. So you need to diversify your partnerships and work from that. And that's going to get tricky, or even more tricky, when this world starts to deglobalize and you're going to have pockets really behaving very differently, maybe even on a macro policy perspective than others. So it's about partnerships. It's about finding assets that are going to constantly grow without too much risk. And it's about, really not sitting in your hands too long. Because to your point, I think the three things you've got to worry about. You've got to be nimble. So you've got to be able to move things around and understand what's going on. You need to be invested because, like you said, cash sitting at a bank with inflation at 7, it's not going to work. And then you need to be truly diversified.
Yeah. Okay. And, let's put you on a tricky spot. The market and the social media today is such that bad news or, worrisome news travels faster than, the good news, right? And that is why you see a lot of people coming out and predicting, every kind of crash. So, but one that has caught my attention is the corporate debt and, the derivatives associated with it. Do you think there is upcoming crisis on the corporate debt side of things?
I'll actually challenge that. I would say that the news at the moment has actually been more, even bad news is good news. We've been in an environment for the last 5-7 years where you haven't had to worry about a massive down because the Fed or the central banks are going to print money and going to push it up. There has been a bullish bias towards it. It has been a very good time to be invested. And I think arguably every time we have a little bit of bad news, gets to a point where people say, okay, this is too bad, someone's going to step in and save the day, and it turns positive. Yeah. You have positive news is positive, negative news is also positive eventually. I think that the risk is that that's starting to change. And tying it back to your question, I think the canary in the coal mine is the credit markets, is corporate credit. Yeah. Corporate credit, unfortunately, doesn't have the same upside as equity, but we have the full downside. So bonds don't typically, go to 140, 150, but we can go from 100 to 0. Yeah. So that asymmetric risk means you need to monitor your risk and return very closely. Unlike maybe even equity, where you've got a higher return profile, so the risk can be, you can have a higher risk. And what we're seeing at the moment is the risk in corporate credits, the risk of companies being able to maintain the same sort of earnings, given labor costs are going up, supply chains are difficult, you're having businesses maybe struggling given policies or politics. That is a real concern. And we think that is where you're going to feel the pressure first. Probably one of the biggest points, if I'm a little bit more specific, would be leverage loans. Yep. The idea that people can take a floating rate note, a company can take a floating loan from a bank. It's been so low for so long, and they can use that to finance, and it was cheap, so they take more and they take more, and now, wow, I need to start paying this back. And arguably the covenants, the requirements on the company to take this loan has got easier and easier over time. So it's a bit like you hear the idea that you just get credit cards sent in the post. A few years ago, credit cards sent in the post, you just choose whichever one in the post you want to use. That was where there's just too much credit in the system. Yeah. We probably had too much credit, and now the credit arguably could be the place that we see the canary really get in trouble.
Yeah, your answer, it absolutely covers every angle of it. And, not only are we seeing, upcoming signs of distress in the corporate credit side, but, also on the individual credit side, I think loans and credit is available too easily. For sure. And, especially with the, technology markets like technology marketplaces like BNPL, etc. So you think corporate credit market would be the canary in the coal mine?
I think that's going to be one of the places we're going to feel the pain first. The central banks have come in and protected that. It's a huge part of the economy. But if they keep to their rhetoric and will allow some pain, yes, that's the problem. To your point, I think technology has been fantastic in enabling a lot of this. Everything from private credits to household pay now, buy later, or buy now. You know,
Yeah.
you know what I'm getting at.
Yeah.
But at the same time, I think it's also interesting to note that technology may be able to help this in the future.
Yep.
This idea of being able to analyze credit better systematically instead of having lots of credit analysts using technology to crunch a lot of the numbers and highlight the red flags. So I think this crisis will again enable more technology, more use of technology to help in the future, but we're still going to get through the crisis first, or potential crisis, or potential, escalation. I'm not calling it, like I said, any event that's got a great before. I think we're going to have a long slowdown, and that's going to probably feel some pain.
Right. Yeah, no, absolutely. Now we come to the most interesting part, because none of these discussions are complete until and unless you talk about China. And you talked about the 3Ds, that are troubling them. What is your outlook on China right now in geopolitics, economy, and where do you see this? When do you see this getting better? Because it seems to be getting worse right now. So your view on that.
Well, I think I've got to, upfront say my bias. I moved from South Africa to the UK, feeling that the UK and Europe offered a massive growth opportunity for me personally, coming from South Africa, which was, struggling at the time. From the UK, I felt after 10 years that the real growth engine is actually Asia. Yeah. This is the growth engine for the next, 100 years. So I moved family and everyone over to this side, and we're happier. And largely, for at least the next, I would say, 25 years, China is going to be the material growth engine. It'll hopefully be supported largely by Indonesia and India in a while. But if you are in this part of the world and you believe Asia is going to grow, you believe that China has huge potential. And I do believe it's a huge economy. It's an economy that can be molded and shifted with much more ease than other economies through the political history and all the rest of it. And this has shown by the aggressiveness of the growth of how it can. So I firmly believe that whilst the 3Ds we've touched on are a big struggle for China, they also have more levers than other countries to be able to move forward. And I do believe that their structure is pretty constructive. It's not perfect. No, I don't think any structure is perfect, but I do believe that the levers are available for this to keep moving forward. They still have a lot of dry gunpowder. If you think of the amount of QE that Europe and the US did, China's done very little. They've started putting in stimulus, but it's still pretty measured. They've got hangovers, but so do, as I said, Europe and the US. So I think that the space on the long term is very interesting. On a medium term, we think that the opportunities are going to come when there's a little bit more clarity around the politics. At the moment, we're waiting for, will this political event happening in October allow for more power to be able to say, okay, now we're really going to ease. We through that, we've got the certainty for the next long period. Now this is what we're going to do. This is the plan. We're going to really lay it out. That could be the case. That could be very constructive to change the rhetoric. In the short term, it's about being selective. What I mean by that is it's not uninvestable. Reason being, as we said, the long termers are there. The market is massively underpositioned. Many investors are just taking all their exposure out. Sentiment is very negative. Valuation is attractive. So there is a saying in finance, be greedy when others are fearful, be fearful when others are greedy. Yeah. And I think the author of that, Warren Buffett, is definitely not someone that just buys everything. He doesn't buy ETFs, but he really focuses on understanding the company, understanding the sector, and diving in. So I think that's how you want to invest in China now. You want to understand the sectors that are being supported by the government, that are supporting long-term growth, and go in there first. And then later, when you get more clarity, you can go into the broader space. And as this gets more clear, the whole region is going to clear it. So there's going to be, further growth potential within the Vietnams, the Philippines, the Indonesia, India, etc. as you go along.
Okay, and in this environment, with all the stuff that we have talked about, what is the most interesting space that you are seeing? Where are you the most bullish?
Well, as I said, there is no home run, I'm afraid. There is no one place that we're super bullish. If I had to choose on one, it would be the theme around security. And for that would be energy security, so infrastructure plays. Underinvestment in infrastructure and energy is huge still. There's a huge transition that's going to go. So there will be interesting opportunities within energy and within making dirty energy more efficient, because I think most people are realizing you can't just turn that tap off. We have to make it cleaner. So that's a space within the security I think is really important. Food security. Unfortunately, the environmental factor has really shown that this is a problem of today, not of 50 years' time. And food is being highly affected. As populations grow, food security is going to be key. So again, that's a space highly interested in. Unfortunately, you've also got defense at the moment, which is because of the breakdown geopolitics, defense, building up that side of the defense is also something that is becoming more attractive. We've touched on the supply chain security, so having your own big machines to create your own chips or to create the certain technology that you have to have, that if you get cut off, you can still move forward.
Yep.
That's going to become ever more increasing as you see what's happening with the Russia crisis. So I think those are probably the key. If I was looking for some sort of home run, high conviction, would be around that space. But really our portfolio is that and many more bases filled, many more income solutions along the way.
Absolutely. And we are, I could hear your tone, like, because this is a grim world, what we're talking about, defense, energy security, etc. These are very challenging times to, be putting money into all of this stuff. Now, coming to the theme of technology, you were talking about credit crisis and all of these stuff. Now, this is a large amount of variables that you are, looking at. Now, we had this discussion about, using technology, getting all of this together. Now, a lot of banks are now saying that discretionary portfolio management should also be done via technology. So portfolio should be changing based on this data coming in and, similarly those things. Are you looking at something like that? Is that even a viable option for something like a discretionary portfolio management?
Look, discretionary portfolio management is another word for an asset manager within a private bank. So the question basically is alluding to, can we automate asset management? Can we go down the route of purely algorithmic tradings, etc.? So then it comes down to the idea of, is the model smart enough? Have they learned enough that they can, foresee, or at least with a high probability, position for what's going forward? And I think, if anything, there's been a step back from this idea that the machines are smart enough now to take over because of this huge uncertainty, potentially policy mistakes, and all the things that are happening at the moment. Could it predict a war? Could it predict inflation spike in the side? Could it predict a Fed that will continue hiking right through the whole of next year? It's not a base case, but could happen if inflation keeps going. I think people are saying, wait, I don't think I trust the machine enough yet. Yeah. But I can't deal with the amount of information without the machine. So now it's about which firms can marry the two together the best. It's not just about hiring someone and saying, push the button. It's not about saying, don't use the computers, keep the same old way because it keeps working. It's about which guys can connect with the systems, connect with the IT legacy that's in some big banks. Yeah. How do you break those down? How do you partner with the right people? How do you partner with the right tech to be able to tie the two together? The guys that can do that best are the guys that are probably going to be performing the best in the future.
Okay, and absolutely perfect answer. So, and now we are coming towards the end of our show. I want to put you on a tough spot again. 5 predictions for the next 12 months. What do you think is going to happen?
Gee, this is getting tougher and tougher.
Yeah.
The next 12 months.
Yep.
Okay. How about I split it? 3 on the market and 2 on technology, for instance.
Absolutely.
Okay. So I think for the next 12 months, we're going to see dark clouds. Unfortunately, that means we're going to have recession. We're going to have much more focus on a slowdown. We've had incredible run up, and I think that's going to start coming off. So we're going to have to see and really focus on capital preservation and income in this environment. I don't think we're going to have a huge spike up. So my prediction would be we're going to see lower lows than we did in June with regards to the major sentiment indicator of the world, which is the equity markets. So lower lows there. I think investments-wise, the split of deglobalization will continue. I think if Russia tomorrow said, we want to be friends again, the world is not going to turn the taps on to the same ability. It's going to take a long time for this to repair. At the same time, there's many large economies which are going to realize that we can't take that risk. We can't take the risk that we get closed off. So this deglobalization will take some time. For the next 12 months, it's going to be a big theme, I think. We've got a lot of politics, midterm elections, you've got Europe, you've got a lot of emerging markets that are playing through. So the idea of more geopolitical risk, more friend sharing, that kind of stuff is going to definitely be on the cards. The other one I think that's interesting, closer to home, would be a giant will be reawakening. We haven't touched on Japan. Japan has been pretty boring for a very long time. We shouldn't forget that they were one of the biggest companies in the world, right? Not biggest companies, the biggest economies in the world. I'm not saying they're going to be, again, the biggest economy, but the shift from most portfolio managers having less than 10%, less than 5%, to the delta increasing, to just think about this for a second. You have, I think the number is $6 to $7 trillion US dollars worth of savings in Japanese bank accounts. Huge number that's just been sitting there, never felt inflation, or not for the last 10 years. Not worried about it. My money's fine. Yeah. Inflation is now slowly eating away at that money. They need to start moving it. That is going to start with a home bias, investing in Japan securities, bonds, equities, houses, you name it. That's going to start shifting focus. The currency's weak. We think it's going to get stronger. People are going to start piling in. I think Japan's an interesting place to view from a macro perspective. Many different places to dive in there. I think those are my three big takeaways for the markets.
Yeah. One question. For a very long time, what I've heard is when you invest in Japan, either you are betting for or against the yen. Has that changed?
I think so, because basically the yen was seen as a safe haven trade, right? It was largely driven by outside factors. And that's what's been driving it for the last 12 months. And it's been a lot of force. Now those factors have basically run its course. Now the next stage that we should start recognizing is the idea that Japan's economy will drive its own currency to a point. It's not just the interest rate differential. So the reopening, Japan hasn't really reopened yet. The idea that wages are starting to go up for the first time in years, that you're having a change in policy. These are all interesting things for an economy that's been pretty sleepy.
Thank you so much. That was amazing. Need you to relook into the crystal ball and two trends from technology for the next 12 to 24 months, let's say.
Okay, so not an easy one, but again, maybe from a perspective of investing, something that I think is shifting materially fast is this idea of open source software, the power, the innovation that has been happening in open source software. Let's use Python as an example. That hasn't, for a large degree, been brought into the investment world except for quant funds. I think in the next 12 months, you're going to have a lot more investment houses that are going to say, I'm going to work with my traditional providers, Bloomberg, Reuters, internal data, and I'm going to maximize some of the incredible libraries that have been created in places like Python. I'm going to start creating minimal viable products, MVPs, which is going to show what I really want. Instead of trying to take them from the shelf and trying to tweak them, you're going to be able to really get that idea across better. And maybe it's also not just through Python, it's the low code, no code kind of solutions. Because I think what is struggling in the investment world is articulating what you want without having that programming background. Yeah. Now you have enough people that can understand what you want from an investment perspective and can make it practical. I think that's going to be a big shift in investment practices in private banks, where teams are going to be using more information more actively and be able to distill that message. I think that's going to be a big one on the tech side. I think, again, in the same sort of manner, will be tie-ups. So we're going to see a lot more technology aligned with that alternatives bucket I was talking about, to make alternatives more available to everyone. Alternatives is arguably only available to ultra high net worth who have very deep pockets that can last for a long time. So making alternatives more liquid, more transparent, more trustworthy through maybe blockchain, IoT, understanding the information better. Those are probably the two big ones I think we're going to see over the next 12 months. Progress in them. We're not going to get to a finish line, but definitely progress in both.
Okay, now we take back your crystal ball and we give you a time machine. If you could go back to any time in the last 3 years, what would be 3 things that you would change?
Wow, that is a tough one. What's happened in 3 years? Well, I'm not going to get political because obviously, I'm not going to say go back to before the war or before XYZ. But if we're thinking from an investment perspective,
investments, yes, of course.
So, okay, what would you do in the last 3 years that would be different? I think we probably didn't need as much pain if this is your time machine, we probably didn't need to feel as much pain with digital space than we did. That was a very hard learned lesson, right? People did extremely well, to the point that people were retiring or just about to retire or putting all their savings into an asset class that, and then we had this clean out. So if I had to change things, I would wish that the clean out happened without the tulip-like acceleration, because I do think that digital assets offer a great opportunity. Some people's fingers have been burned so badly they're never going to touch it again. Yeah. Even the technology, which has a great space. So I think the main one would be over the last 3 years, take away that extremism and maybe done the washout earlier on, so we could get now to the stage, which could be 3-4 years away, of, okay, now we're past that. Now let's think about the longer term picture, how we're going to make this work.
Yeah, absolutely. So that is one thing that you would do differently from your own investing perspective.
Own investment perspective. I think like a lot of investors on the personal front, it's about being invested. When I say that is, a lot of people are probably sitting on too much cash. I think you want to be invested, you want to be active. A lot of people will, as they fear, particularly, I mean, money is so emotional. So when you start feeling fear, you just pull back. You don't want to lose your own money. You don't want to lose other people's money. As a professional investor, I think you want to reiterate during these real big spikes, and we talked earlier on about the frequency of spikes are increasing. I think we're going to continue to see that, and I think investors need to have a longer term view. And over the last 3 years, some investors have just taken all the risk off. They've missed this. They've been whipsawed on the last one. So I think you would want to tell people, if you went back in a time machine, stay invested. Maybe manage your risk return slightly better. Maybe focus more on diversification, but stay invested. Cash is only now started getting interesting over the last 6 months. For the last 3 years, cash has not been king.
Right. And one thing that you could change about the banking industry.
Banking industry.
Or the financial industry, of course.
Well, the banking industry has been around for 100 years, right?
Yeah.
And that trust factor has been built on, iterations of humans of the humans of the humans. I think if I had to go back in a time machine way back, I'd probably have a personal opinion. I'd have all bankers understand the logic of coding. The reason being, because you can then you systematically can break a problem down in maybe a logical way that kind of flows. I think banking needs a certain logic. You need to be creative. You need to understand it. But when you understand the guidelines of what's possible, what's not possible, your imagination gets even more creative. So I think that if we had to go in a time machine and say, as long as people understand what's possible, it means they can think even bigger. And arguably, when you have discussions with people that are really changing things, their boundaries of believing what's possible is bigger. And in finance, which is so data-driven, having that understanding of what is possible with data, with technology, expands it. So to me, that's quite exciting. If we had to go back in time, people that could dream bigger because they can see what more can happen, at least from a finance perspective.
No, absolutely. And, all the IT people and computer science people on our episode are like rejoicing because they love your answer. And personally, I see a lot of merit to it as well, because, with the amount of automation, AI, machine learning coming in, you have to know how this works. Even if you're not doing it on a daily basis, you need to know how it works. So thank you so much for all the insights, being so candid and, sharing your views on how investing, the world, and, technology is changing around us. So thank you so much for joining. Everyone, please follow Gareth on LinkedIn. He does some amazing stuff. And, that is the least we can say. And thank him for, coming on the show. So thank you so much.
Pleasure. Thank you very much.
Thank you.